Hi, you're watching TechCrunch TV, and my name's Colleen Taylor. Many California entrepreneurs and investors are about to get a tax bill they never expected. The state has eliminated a tax break that had been available when holding stock in startups. The change is not for this year. It's being retroactively enforced back to 2008. It could force anybody that has used a tax break over the past 5 years to pay more in taxes, along with interest and possible penalties. We spoke to some experts who explained. First, I sat down with Brian Overstreet, a California entrepreneur who's been speaking out about these changes.
Right off the bat, a lot of us are going to have to write big checks, which nobody likes to do, and that can have a real financial impact on us all individually. But longer term, you're talking about a situation where we've all been hit with a retroactive tax. And that's not going to leave a good taste in anybody's mouth, and especially when you factor in the high cost of doing business in this state, the very difficult regulatory environments that we face in the state, and now you're telling me that I have to worry about what I might have done 5 years ago, that I thought I did everything right. It's just mind-blowing, and I'm not sure how people are going to feel about starting up and investing in this state when this sort of thing happens.
For the past 20 years, California has been a relatively good place for startups and the people who invest in them. That's because in 1993, California created a significant tax break for people who held stock in small businesses valued under $50 million that kept 80% of their assets and payroll in the state of California.
So both on the federal and the state level, there are qualified small business tax exclusions or deferrals. On the state side, it used to be that you could exclude 50% of your gain from the sale of the stock of a small business, a qualified small business. So what that means in plain English is you pay half the tax that you normally would to the state of California on the sale of your stock. And unfortunately what they've done, or what's happened now, is that that exclusion's gone away. So in our situation for 2012, we're paying the full tax rate like we would for any other sort of income. But the real problem is they did it retroactively going back 5 years. So you have people who are in my position who sold their companies 3-4 years ago who have spent the money or reinvested it, or just don't necessarily have it anymore. And they're going to get a retroactive tax bill, a back tax bill that's going to actually include interest as well.
The root of these recent changes is a lawsuit that was filed against the Franchise Tax Board by a businessman named Frank Cutler back in 1998. He alleged that the existing tax structure was unfair, and 14 years later, in August 2012, a ruling was finally reached in his favor. As a result of Cutler's case, California's former tax break that benefited local small businesses and their investors was voted unconstitutional. And per this ruling, the tax board decided in late December that anyone who benefited would have to pay back the past 5 years of taxes they saved under the old law. I also sat down with David Herbst, a partner at Silicon Valley law firm Manat, Phelps & Phillips. He explained exactly what this ruling means.
In effect, the tax collector, the Franchise Tax Board, lost the case, but in losing the case decided that they would take a very proactive step of turning it into a tax collection bonanza rather than just becoming a big refund lineup.
Herbst says that people who are impacted by this change could stand to pay out 6 figures or more.
The case that they were dealing with was several $100,000 of taxes involved by that one taxpayer. I've seen some situations with clients that I've worked with where it is hundreds of thousands of dollars.
People who are impacted by this change should expect to see bills in the mail very soon.
Statute of limitations on 2008 tax returns will start to expire on April 15 of 2013. So if they're going to collect any assessments from the 2008 year, which is the earliest year that's still open, they would have to get those assessments out by April 15 of this year. So we should be expecting them shortly.
So what can members of the technology and startup communities do? Overstreet says that people who oppose this change should contact their state assemblymen and women.
The only thing we can do at this point is go to Sacramento and get some sort of action out of the assembly to change this law. The Franchise Tax Board doesn't make law, they enforce law. And so the fault doesn't necessarily lie with them, they're doing their jobs. But somebody has to hold some responsibility and say, yes or no, this is right or this is not right. And listen, this was not put to a popular vote. This was not done by any form of proper governmental authority. It was the enforcement of a court case.
Now, this is a story that's going to continue to unfold over the coming weeks and months, and we at TechCrunch are going to keep on top of it. So please check back for all the latest.